Had some huge news for stock market investors as President Donald Trump said that the threatened tariffs on China are not sustainable. So I'm going to go over the details of this announcement and what it could mean for stock market investors because the tariffs and the increasing trade barriers I see as one of the biggest risks to the stock market. And the trade barriers against China is the most volatile, though region that's being under the highest percentage increase in tariffs. So it's really important for all stock market investors to evaluate the impacts and the decisions surrounding these trade barriers. I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. All right, so President Donald Trump said that the high threatened tariffs with China were not viable as tensions between the two largest economies intensified last week. Remember, China instituted new barriers, new restrictions requiring businesses to ask for licenses before certain um, commodities could be exported, so rare earths as they're being called. And then the United States retaliated by increasing or threatening to increase the tariff against imports from China by another 100% effective November 1st. That's the number that President Donald Trump is alluding to when saying that this number is not sustainable. Trump said in an interview with Fox Business. When asked whether the levies he has threatened to impose on China could remain in place without significantly affecting the economy. But that's what the number is. It's probably not, it could stand, but they forced me to do that, he added. So the president saying that the number is not sustainable, but that's the number where it is. And I think this is part of President Donald Trump's strategy in instituting these tariffs, especially against China, is the volatility, the uncertainty, the vagueness, the uh, up and down. Maybe it is, maybe it isn't. Maybe next week I change my mind. Maybe I don't. Maybe I'll increase it by 500%. Maybe I'll decrease it. Maybe I'll do this. Maybe I'll do that. That's part of the strategy. And the strategy is aimed at, while the strategy may appear to be aimed at China, the strategy may also be aimed at U.S. businesses in giving them more reason to stop importing products from China. Because if the number, let's say, as it stands, it's roughly 55% the effective tariff rate against Chinese business, against imports from China, businesses can adjust to that circumstance, right? If you tell a business, look, the tariff is 55%. Okay, an entrepreneur, a small business owner can take that number. It can make calculations, it can make adjustments, it can change product features, it can work with the supplier, it can work with transportation agencies, it can work with distribution channels, and it can adjust to the new circumstances and continue business as usual. Right? Well, I shouldn't say business as usual, but it can continue doing business in mostly the same way it was doing business before, which is importing a lot of the products from China or from overseas. Well, the current administration doesn't want that. The current administration doesn't want businesses to import products from China. They want businesses to manufacture products in the United States, and they're trying to find ways to achieve that goal. If that is the goal, of course, we're assuming that's the goal of the current administration, because that's what they've said in why they're implementing these tariffs is to bring back manufacturing, bring back supply chains to increase security. Because if you're a country and you're dependent on the imports from everywhere outside of your own country, you're at risk because, as you're seeing with China, they can restrict the exports whenever they want. And as you've seen from the United States, restricting the exports of certain um, technology, certain semiconductor chips, most notably from NVIDIA, their most advanced technology is restricted from being exported to China and other regions as well. So if you want access to certain technology, you want to be able to have that technology within your shores. So this trade war ups and downs, tariffs going up, tariffs going down. I think this week investors took some account for the increasing risk, the volatility, because for a few months there hadn't been very much volatility. There hadn't been very much negativity in trade barriers, increasing geopolitical tension. And so I think investors were getting a little calm, a little too complacent in seeing this as, oh, it's just going to be 50%, businesses will adjust and move forward. And I think the tensions from last week and now this week are bringing it to the front of investor attention. Like, maybe this isn't just going to be a 20% or 50% increase. Maybe there is more behind these increases. Maybe these are just the opening moves in a bigger and longer uh, situation where the United States is trying to significantly decrease its dependence on imports from China and other nations where it sees it as a risk to its national security. So I think investors need to account for this and need to consider the increasing risks as a result and look at your portfolio and see what companies are exposed to these risks, these increasing trade barriers, because it doesn't look like it's going to be a quick fix. It doesn't look like there's going to be a deal, so to speak, where they agree to continue uh, their relations as was the situation before. It looks like it's going to be a situation, as we've seen with other deals with other nations, where the United States will impose higher trade barriers and try to restrict the amount of imports coming from outside. So if you want to sell to US customers, the United States wants you to manufacture in the United States. So if you want access to this, you know, over $30 trillion annual sales economy, then the administration wants you to be producing products here, manufacturing products here, adding jobs here in the United States. And if you're not, then you're going to be at a competitive disadvantage, is what the current administration looks to be implementing as it stands. It's very confusing. It's always changing. And I think that's on purpose. I don't think the administration wants businesses to get comfortable and make adjustments and still manufacture overseas. Because with the, like is the case with other, deals that have been implemented with other countries, the tariff rate has been between 15 and 25%. And with China, it's about 55%. Businesses can deal with that. Businesses can make adjustments and arrangements and still import with that additional tariff. And, maybe their profit margins will be hit in the near term, but over time they'll raise prices on consumers, work with suppliers, make adjustments to product features, maybe discontinue some products and add other products that are less impacted by the tariffs. But an increase of 15 or 25%, or even 50% for that matter, is not going to be a major tipping point that takes a business that's manufacturing outside of the United States to go and say, okay, we need to bring manufacturing to the United States now because there's a 20% tariff or 30 or 40 or 50% tariff. That number is not large enough to make up for the difference in the cost of manufacturing in the United States versus the cost of manufacturing wherever else you're manufacturing. The costs are almost likely double, at least double here in the United States compared to wherever it is around the world that you're manufacturing. So 20, 30, 40, or 50% is not going to be that factor that causes you to make that switch. But the increasing volatility, the switching, the ups and the downs, and the 100% increase and then 50% decrease, and then the restrictions of what you can and cannot import, and all of those things, that might indeed cause businesses to say, you know what? We need to onshore our manufacturing, not because of the 20 or 30 or 40%, but because we can secure our supply chain. We won't be exposed to restrictions. We'll have the products that our customers want. Maybe we'll have to pay a higher price, maybe we won't, but at least we'll know we'll have the product. So it's a rapidly changing situation that investors need to keep a close eye on. And of course, I'll have all of the latest details for you as they come to my attention. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.